The signal buried beneath the noise. It was there the entire time, hidden in plain sight. Not dramatic, not alarming, just a signal so subtle it was drowned out by louder stories, bigger numbers, and constant distraction. It did not demand attention, and it did not attempt to compete with spectacle. It simply persisted, quietly registering changes beneath the surface while the spotlight remained fixed elsewhere. In an environment obsessed with immediacy, subtlety rarely survives. And yet, this signal endured, steady, patient, almost indifferent to whether anyone chose to see it. This story matters now because markets are noisier than ever. Headlines arrive every second. Opinions clash endlessly, yet the most important signals rarely shout. They whisper, and when those whispers are ignored long enough, the consequences tend to arrive all at once. To understand how a quiet signal foretold a major shift, we need to go back to the moment everyone was looking in the wrong direction. We need to return to a time when confidence felt rational, optimism felt earned, and skepticism seemed unnecessary. That is often when vulnerability is most deeply embedded, during periods when doubt appears irrational. It began during a stretch of relentless optimism. Markets climbed steadily. New records became routine. Commentators debated how high things could go, not whether they should. Data releases were strong enough to justify confidence, but not strong enough to explain the speed of a rise. Valuations expanded under the assumption that momentum itself was evidence of durability. Narratives reinforce each other, creating a feedback loop between price action and belief. The environment rewarded participation, not caution. Beneath that optimism, one indicator behaved differently. It didn't collapse. It didn't spike. It simply stopped confirming the story everyone believed. While prices surged, the signal flattened. Then it softened, barely enough to notice, easy to explain away as temporary distortion. It was subtle enough to avoid triggering alarm, but persistent enough to resist dismissal by those who looked closely. The divergence was not dramatic. It was structural. Most ignored it. Analysts focused on growth metrics. Traders watched momentum. Investors chased performance. The signal didn't fit the narrative, so it was dismissed as outdated, irrelevant, or distorted by unusual conditions. After all, nothing else suggested danger. Price trends remained intact. Liquidity appeared supportive. Volatility was subdued. The broader environment seemed stable. In such conditions, internal discrepancies feel academic rather than urgent. But signals don't need consensus to matter. They only need consistency. Quietly, the divergence grew. Each new high in prices was met with a weaker response beneath the surface. Participation narrowed. Strength concentrated in fewer names. Liquidity looked abundant, but only where excitement remained strongest. Capital clustered around leadership, while secondary assets lagged without drawing attention. From a distance, the market appeared unified. Up close, it was fragmenting. Those who tracked the signal closely noticed something unsettling. The market was advancing on thinner ground. It wasn't breaking, but it wasn't broadening either. The foundation was narrowing while the structure above it grew taller. Gains relied increasingly on a concentrated group of assets carrying disproportionate weight. When leadership carries too much responsibility, stability becomes conditional. The early reveal wasn't fear. It was imbalance. An imbalance, left unattended, has a way of turning silence into shock. Not because collapse is inevitable, but because fragility increases when participation contracts. Markets thrive on distribution of strength. When expansion gives way to concentration, resilience declines even if price remains elevated. The signal wasn't dramatic because deterioration rarely announces itself. It accumulates quietly. The signal wasn't predicting collapse. It was warning that the noise was hiding something essential, and almost no one was listening. As the noise grew louder, the signal grew lonelier. Each rally was celebrated as confirmation, yet fewer participants were actually driving it. Volume clustered around the same assets. Breadth narrowed further. The market was rising, but participation was quietly retreating. Gains became dependent on consistency from a shrinking leadership core. Stability looked strong because the strongest names refused to falter. The reveal deepened when short-term pullbacks began behaving differently. In the past, dips were met with immediate, broad-based buying. Now, recoveries depended on the same narrow group of names. Outside that circle, weakness lingered. Losses didn't reverse cleanly. They just stopped falling. Rebounds lacked the synchronization that once defined healthy momentum. What appeared to be resilience was, in reality, selective reinforcement. This was a signal speaking clearly. Internally, risk was rotating, not disappearing. Capital flowed defensively beneath the surface, while optimism stayed visible at the top. Hedging activity increased. Protection was purchased quietly, without urgency. The market looked confident, but it was preparing. Defensive sectors stabilized before cyclical ones. Correlations shifted subtly. None of it was loud enough to dominate headlines, but together, the pattern formed a warning. The early conflict emerged when good news stopped producing strong reactions. Earnings beat expectations, yet prices barely moved. Economic data surprised positively, yet rallies stalled quickly. Momentum existed, but it was fragile, requiring constant reinforcement to survive. Markets that require continuous justification for strength often signal internal exhaustion. Those watching the signal understood what this meant. Strength without participation isn't strength, it's concentration. And concentration increases sensitivity. When leadership narrows, the market becomes dependent on fewer supports. Remove one, and pressure multiplies. Diversification within the index gives way to dependency within it. The structure appears intact until stress tests it. Still, the majority dismissed concern. They pointed to indices, not internals, to charts, not structure. The signal was too quiet to compete with excitement, too subtle to challenge belief. In environments fueled by optimism, caution feels contrarian. Attention follows price, not participation. But markets don't turn because of loud warnings. They turn because of ignored ones. And as the divergence stretched wider, the signal stopped asking for attention. It started preparing for consequence. The consequence arrived gradually. Then suddenly, one of the market's leaders stumbled, not collapsed, just slipped enough to test confidence. In a healthy system, leadership rotates, strength migrates. But this time, there was nowhere for it to go. The assets that might have absorbed a shift were already weakened. The structure lacked depth. The conflict intensified as selling spread outward. Assets that had been quietly weak for months offered no support. Buyers hesitated. Liquidity thinned. The same narrow group that had carried the market up now carried it down. What once looked like resilience revealed itself as dependence. And dependence, once exposed, accelerates vulnerability. Volatility surged, not explosively, but persistently. Each rebound failed faster than the last. The market felt heavy, exhausted. Participants who had ignored internals now scrambled to understand why prices behaved differently than before. The answer had been visible all along, but buried beneath noise. The structural imbalance had not caused panic. It had removed cushion. Forced reactions followed. Stop losses triggered. Risk models adjusted. Funds reduced exposure simultaneously, not because of panic, but because the structure no longer held. Algorithms responded to correlations that tightened abruptly. Liquidity providers stepped back as uncertainty rose. The signal that once whispered now echoed through execution. Correlations snapped higher. Diversification failed. Assets that should have offset losses moved together. The market didn't unravel through fear. It unraveled through realization. The realization that strength had been narrower than anyone admitted. When participation contracts, synchronization increases under stress. As selling accelerated, narratives shifted. Confidence turned defensive. Analysts revised outlooks. Commentators searched for catalysts. But the truth was uncomfortable. Nothing new had happened. What changed was attention. The signal had been warning about participation, not price. About foundation, not height. And when the foundation finally mattered, it mattered all at once. Markets do not collapse because price is high. They destabilize when structure weakens unnoticed. The noise fell silent. And in that silence, the market was forced to confront what it had ignored. The climax wasn't a crash, it was clarity. The market finally understood what the signal had been saying all along. Strength without breadth is fragile. Momentum without participation is temporary. The illusion of stability evaporated once the narrow supports gave way. What had been interpreted as efficiency revealed itself as imbalance. The resolution unfolded through reset. Leadership rotated. Excess unwound. Markets became less efficient, but more honest. Prices reflected broader participation again, not just concentrated belief. Risk was redistributed rather than hidden. Volatility normalized as structure rebuilt. The system relearned balance through discomfort. For those who had listened early, the signal wasn't a prophecy. It was a guide. It didn't tell them when to act, but it told them what to watch. When the noise was loudest, it showed where the silence mattered. It emphasized structure over spectacle, confirmation over excitement. It rewarded patience rather than reaction. Modern relevance is constant. Today's markets generate more information than ever, yet the most important clues remain subtle. Participation, structure, and internal health still whisper, while headlines shout. Breadth, liquidity distribution, correlation shifts. These remain foundational, even when overshadowed by price milestones and narrative momentum. The challenge hasn't changed. Attention has. The signal buried beneath the noise didn't fail. It was ignored. And when markets finally listened, the lesson was already written in losses. Subscribe to join the journey. The